We now want to look at the Mundell-Fleming model and take expansionary fiscal policy when we're operating a fixed exchange rate system. We know that fiscal policy initially impacts the goods market, so that's going to cause your IS curve to shift to the right. So let's have a look at that. So your IS curve shifts rightwards, and as a result we can see that at the new equilibrium your interest rate is higher. So your interest rate is now, the domestic interest rate is higher than those prevailing in world or foreign markets. And that's going to lead to a capital inflow. So financial capital is going to chase the higher yield here domestically. There's going to be increased demand for domestic assets, and there's going to be pressure on the exchange rate to appreciate. So pressure for the local exchange rate to appreciate. But remember, we're operating a fixed exchange rate system, so it can't appreciate. The central bank's got to do everything in its power to try and preserve the peg. So they therefore need to provide the currency that people want, the domestic currency. So the central bank's going to have to increase the money supply. And what does that do? We know it affects LM, money market. So we shift our LM curve to the right. Increase the money supply and we get a new equilibrium. We'll call it E2. So has that been effective? Yes, it has. We see that income has risen. Output or income has risen, which is the intention of that expansionary fiscal policy. Interest rate hasn't changed by much, and we can see that under a fixed exchange rate system, when you have got perfect capital mobility, as the Mundell-Fleming model assumes, fiscal policy is effective, accompanied by that increase in the money supply as the central bank defends the peg, and we find an increase in output. Whereas, as we saw previously, monetary policy is ineffective. So if you want to maintain a fixed exchange rate system, you forego monetary independence or monetary autonomy.